Welcome to the July 2011 Economic Update. This monthly podcast is brought to you through a partnership between Modern Distribution Management and the Manufacturers Alliance, MAPI. This month features economist Chris Bladowski. Bladowski's expertise centers on European economies, particularly Poland and Eastern Europe. In addition, he formerly served as a senior economist for the International Monetary Fund. Hi, Chris, and thank you for joining us today.
Hi there.
So, what is the state of the economy in Europe right now?
Well, the growth rate in Europe is solid, but not very uniform. We have some countries, particularly Germany, Austria, Netherlands, Sweden, which are growing fast, and their growth rate is based both on manufacturing and services. And then we've got quite a few countries in the southern periphery. Ireland is a notable exception in the north, but Greece, Portugal, Spain are not growing very fast. So growth in Europe is relatively okay, but not very uniform.
Okay. So for those countries that are in crisis right now and not growing as well, what are some of the causes?
Well, in Greece, we have witnessed rather reckless accumulation of public debt. Also, personal consumption grew beyond the country's means. So in fact, that spending exceeded production. We can find that in persistently high current account deficits, as you can see on the slide. On the other side of the spectrum, we see Spain and Ireland. You could almost say that by European standards, they were examples of probity. As a matter of fact, government debt levels in these two countries remained below those of Germany as recently as the end of 2009. At the same time, pretty much everywhere unit labor costs climbed while productivity stagnated. Eurozone's uniform monetary policy, I believe, has turned out to be too loose for some countries on the periphery and too tight for some of the other countries. And as a result of these low interest rates, home construction in Ireland and in Spain in particular boomed, and that led to a housing bubble in these two countries.
So what's in store for Greece, Portugal, and Ireland in terms of what they need to do now?
Different countries will require varying policy responses. For example, in Greece, Ireland, and Portugal, these countries face mounting fiscal woes at this point. But then separately, Spain and Ireland will also need to work off their excess supply of housing that I mentioned earlier and also repair their banking sectors. I think that economists agree that all economies would benefit from more product competition and more flexible labor and capital markets. That kind of applies to all of these countries. It's not surprising that Southern Europe has suffered from low economic growth because the success of this crisis management will ultimately be judged by whether the region can grow fast enough to gradually pare down its debt.
Well, I know in the news we've heard about bailouts. Can you give us some ballpark figures?
Yeah, the three loans that have been approved so far, they total just shy of 280 billion euros, which is about $400 billion. Now, that excludes the most recent package for Greece, which is still subject to final approval. In fact, it's up in the air, although most likely it will be approved. All the three loans that I mentioned earlier have originated from a combination of European special purpose vehicles created specifically for that and the IMF. The exception here is Ireland, which also drew some bilateral funds from three individual countries. But all these loans shield the borrowing governments right now from either prohibitive costs of borrowing and refinancing in the private market or from outright default.
How worried are the markets that policymakers won't solve the crisis correctly?
Well, there is little evidence that the market remain reassured at this point. If you look at the graph, it tells the story. Rates on government borrowing continue to climb or have continued to climb in the countries of the periphery pretty much regardless of how much bailout money has been provided. I think it's worrying that we see risk premia begin to creep up on Italy and even in Germany. This could very well signal that investors are growing quite queasy with the very stability of the monetary union.
So with all the solutions floating around right now, how do we make sense out of what we're hearing?
Well, there's no shortage of proposals. Some are more far-fetched than the others, whether we look at it politically or technically. For example, the Eurozone could mutualize their public finances, meaning that they merge the public finances of the various countries, by creating some kind of a federal treasury like we have in the United States. Or the Eurozone could introduce dual currency regimes for a limited period of time for those countries which are in distress. But I believe that these are pretty much outliers, and they are unlikely to be seriously considered, at least not in the near term. There are some very pragmatic schemes, however, and I'd like to discuss those. One is the status quo of continued public bailouts as one option, and we've seen that so far. It muddles through, buys time, but basically leaves the debt stocks piling up ever higher. I think a far more sensible proposal would involve what is called bailing in existing creditors through an exchange of various types of existing debt for new issues with similar characteristics. Essentially, it would assure continued private sector financing, but it might trigger what is called a credit event, which would be tantamount to a technical default. Now, another option, which is similar, would have creditors voluntarily swap maturing debt proceeds for various similar issues, new issues, essentially rolling over the debt on all terms so that that would not trigger a credit event. The obvious problem with this very proposal is that you need to convince all of the creditors of the substance of this proposal, and that may not be an easy proposition. And then finally, you can have a much more muscular option, and that would involve having the borrowing governments pay less for maturing bonds. Economists and finance types call this a haircut. Effectively, it would mean paying out less what is due at redemption at maturity. So effectively, this would be a default. As you can see, there's no shortage of proposals, and some are better than the others, but all are very, very difficult politically, and some are very difficult technically as well.
Turning our attention a little bit to the European Central Bank, the balance sheet there is now stuffed with paper of dubious value. Is there a risk that the bank itself might become insolvent?
That's a good point. The European Central Bank had purchased over the past year and a half or so about 75 to 80 billion euros worth of sovereign bonds and much, much more in terms of bank debt through refinancing operations. Just like the Fed, the ECB stands for the European Central Bank, has now a very big balance sheet. When you properly mark to market all of these securities, their value now lies substantially below the purchase cost, obviously because the bond prices have fallen in the meantime. So this does present a problem if the bank, the central bank, were to realize this loss. The ECB might then need to be recapitalized by member governments who effectively own it. Now, such a cash call would be politically very destabilizing for many governments, particularly those from the northern periphery, those who are in surplus and who might end up bailing out the Eurozone. We're talking about possibly some political paralysis, which almost certainly might impact investor sentiment as well. So what it boils down to is possible worsening of the economic outlook for Europe.
Well, let's turn our attention to Greece now, because it's front and center in the news. Who is exposed to Greece's debt, and where is the U.S. in this?
The French and the German investors stand out as the largest creditors of the Greek government right now. If the losses that I spoke about earlier were to be realized, we can expect some damage to the banking sector of these two countries. By contrast, Greek bank debt is widely held, as you can see on the slide, and the amounts are relatively small. Whether we are talking about sovereign or bank debt, U.S. investors are not directly exposed very much. However, if the European continental banks were to suffer losses, those losses might cascade down to the American banking sector through counterparty exposure, banks being exposed to other banks. So in that case, large American banks, particularly those with international links, would then come under pressure or might come under pressure by investors. Then it's quite possible that as a result, less financing might be available to domestic U.S. borrowers if these American banks were to suffer some distress.
So overall, what does all this mean for the U.S. economy?
First, any type of sovereign default that we talked about would shake up markets worldwide, and quite big, I think. Second, as global investment sentiment suffers in this case, this might very well move the European economy closer to another recession. I mean, the European economy just emerged from one recession. Third, if investors were to suffer large haircuts that I had mentioned, some European banks might also face these cash calls that I have just described for the ECB. Now, if this were to ripple through the American shores to the American banking sector, the direct hit to the U.S. banks might not be that big, might be rather small, but it could still impact earnings and asset quality at some of the institutions. It's very hard, by the way, for me to just enumerate which banks that might be or which sectors could be involved. But emergency lending by the Fed to the European counterparts probably will be a reality, just like in the past where the Fed extended swap lines with the European central banks. That probably would happen also should there be a banking crisis in Europe. And then finally, we can probably see some type of a political crisis develop in Europe. And if that were the case, that could buffet policy coordination with the United States. For example, you have poor policy coordination within the European Union itself. So overall, the risks of a double-dip recession in the U.S. would definitely be there, although I think that the risk of a double-dip recession in the United States would be smaller than a risk of a double-dip recession in Europe. To sum up, I would say that the extent of the crisis itself is highly unpredictable at this stage. And what I'm kind of certain about is that none of the policy choices I described are either easy or clear-cut. We are very much in uncharted territory, and how the situation develops is anyone's guess.
Well, there's certainly a lot going on there. So thank you very much for your time in helping us understand this.
Thank you.